All right, I think I had misspoken before when I said that Morgan Stanley was cutting back on its mortgage unit. It's actually J.P. Morgan Chase. I apologize for that. But just to bring up to date, it is laying off or reassigning about 1,000 employees in its mortgage unit. This is the housing market cools. It occurs on the same day RBC, the big brokerage firm, had downgraded Pulte Group, saying that we are in the early innings of a housing downturn. Of course, Pulte, a major home builder, and all the other home builders selling off in concert with that. But although they had been selling off a lot worse earlier. Let's get the read on all of this with Jeff Taylor, the Mortgage Bankers Association board member. Jeff, one of the things we've already noticed in the housing arena is that people are trying to pivot in this environment, some to adjustable rate mortgages, not nearly the type and the risky types that we had back right before the meltdown, but adjustables just the same. Can you give me an update on that?
Absolutely, Neil, and thank you so much for having me. It's great to see you again. So in times like this, where rates have risen so quickly from 3% fixed to over 6% right now, the thing with an adjustable rate mortgage is you can generally get a point to a point and a half below where the 30-year fixed is, but for a smaller duration of time. They could do a 3, a 5, a 7, or a 10. So the people who are going into those loans have one of two theories. Either they believe they can pay off everything that they are taking the loan amount in that period of time, or they're taking a bet that when their loan comes up for refinance, whenever that period of time is over, their rates are going to be lower where they are today. I hope that people who are looking at adjustable rate mortgages right now are doing it because they believe they can pay that house off in a period of time, because nothing I'm seeing with inflation or the economy is going right now tells me that rates are going to be lower anytime soon.
You know, they might also be looking at what's available to them. And even though that is sort of like weighing the risk of holding out for a mortgage that might stay low for 3, 5, 7, even 10 years, it's not like the devil may care adjustable rate mortgages, no doc loans that, popularized the housing boom of the late 90s and early 2000s. I don't see a lot of that craziness going on. Do you?
No, I do not, Neil. And so this is actually what we do as a business at Digital Risk. We're the largest fulfillment company for mortgages on behalf of big banks to independent lenders. Here's the thing. On an adjustable rate mortgage, you're going to have a lot more scrutiny. You're going to want to see more deposits. You're going to want to see more assets before the bank makes that loan. So the underwriting guidelines and framework is going to be much tougher to actually get that. And to your point, this is nowhere near 2008, okay? The housing market's fundamentals have never been stronger. Are we going to see a 20% year-on-year price increase this year? No. It might be 3 or 4, but fundamentally, we have a very, very strong housing market.
Yeah, I mean, I just don't see, having covered that meltdown, any of the giddiness or the devil may care attitude we had back then, where people were flipping property sight unseen. They were making money hand over fist until suddenly they weren't. And the industry and others cracked down on this sort of stuff, even, buying and selling these mortgage-backed securities that were nicely bundling all of that risky stuff. There's always a new wrinkle that we should be afraid of. Any potential wrinkles here that has you up at night?
So the wrinkles that I'm starting to see, and you can imagine this, right? With basically the refinance market all but shutting down with refinance with rates at 6% right now, you're going to see that term of a non-perfect mortgage, not all Alt-A, I wouldn't say subprime, but that credit box will definitely start to be stretched here in the coming months as people are trying to create products that those who are trying to purchase a house can get into. So for example, if rates were at 3%, a year ago right now, they're at 6%. That mortgage payment has doubled. Gas, food, everything's higher. So when you're trying to create a product that a person can get into a first-time house or a house somewhere in the medium home price of $450,000, they will come up with other creative ways to go ahead and fit those mortgages. And a lot of those mortgages, if they don't conform with Fannie and Freddie, will have to sit on banks' balance sheet or become securitized. So I think the scrutiny around those is going to be extremely strong. So not keeping me up at night, but it's not the manila 100% everything in a tight credit box that we've seen for a while. That is going to loosen in the next 12 months.
Very interesting. Jeff, you're the Bible on this. I appreciate it. Jeff Taylor following all of this. And again, this comparison we often make to the 70s, that might pan out. again, there's nothing to give evidence to that for the time being. Sometimes the naysayers can get a little ahead of the curve here. And so far, we're seeing very little of that so far. So we'll keep an eye on that.